All right, see, we got about 6 people waiting to get in. We can start letting them in about 2 minutes till, or 1 minute on the dot, 1:55:59.
Yeah, let's go.
All right, so another 2 minutes, 3 minutes.
Okay. Is Julie here yet? That's
Go ahead, Jake. Go ahead.
Is Julie here yet?
Yep, she's here.
Okay, we should let her in first.
Sure. Yep.
Good evening.
Hi, Julie. Thank you
Julie.
so much.
Hey, you guys, how is it going?
Good.
Going good.
Good.
Nice to finally meet you. Hold on 1 second. Let me turn on my camera. All right.
There
we go.
you go. So Dexter,
Right.
where are you?
I'm in Palmdale, California.
Oh, okay.
Yep. And where are you located?
That used to be like the middle of nowhere.
Yep, exactly.
Have you lived there a long time?
No, I just bought a house end of December here.
Where were you before?
Los Angeles, South Central Los Angeles.
Well, so are you doing a commute? Or are you living close by?
I do a commute every other day. I drive for Uber part-time, so I commute back and forth to LA every other day. And I have vending machines down there, so when I'm going to check on my vending machines, I kind of Uber around town to make some little money and waste time if I won't get caught up in traffic coming back home.
Oh, that's awesome. That's awesome. Yeah, I'm in San Diego. I'm in North County.
Oh, okay. Oh, yeah. You're in SoCal. Oh, yeah.
Yep. Yep. I'm from Chicago, but moved out here about 12 years ago.
Oh, you've been here for a minute now. You consider a native.
I am, right?
Right.
So I want to try to make sure can I share my screen? I just want to try it.
Oh, yeah.
Yep, just trying to get it right now.
Okay.
I'm gonna make you a co-host.
Okay, thank you.
Right. Yep, we got another. All right, I'm gonna start letting people in once we figure this out. It's about
perfect.
5:59.
Oh. I'm waiting for you, Jason, when you get a chance.
There you go.
You assigned.
Okay, let me just make sure. Here we go. All right, so what do you see?
I can see your screen.
You cannot see my screen, or you can?
I can.
Okay, is it full screen?
Yes, it's full screen.
Okay, full screen. Okay, perfect. Let me let him in.
All right.
Perfect timing. Stop sharing.
All right. All right, it is time. Welcome, everyone.
Oh, sorry.
No problem. Sorry about that. Welcome, everyone. Can y'all please drop y'all contact information in the chat box, please? Greatly appreciate that. And make sure your mics are off. We won't have no background disturbance going on. Thank you. Welcome to the first Multifamily Glendale, Pasadena chapter meetup.
Hold on.
Next slide, Jason.
Yes.
Thank you. We'll get it. It's our first go around. All right, everyone. I'd like to introduce myself. My name is Dexter Harris. I'm from South Central Los Angeles. Been an entrepreneur most of my life. Currently own 14 vending machines. And I'm a passive investor on 456 units. And my market that I'm interested in investing in is Texas. Cities are Houston, Dallas, San Antonio, and Arlington. looking to purchase 16 to 32 units as my first investment. Thank you.
Hi, you guys. My name is Jason Malabute, and that's easy to remember because first you get the moolah, then you get the booty. So a little bit about myself, you guys. Started off as a CPA, then transitioned to real estate investing, single family in Indianapolis, Indiana. I've transitioned out of those. Now I'm focusing in multifamily. I'm focusing in the Indianapolis and also Kansas City markets as well. So a little bit of house cleaning, you guys, before we proceed. Our next meetup is going to be on May 25th at 6 p.m. and our special guest is going to be my and Dexter's mentor, Charles Seaman, and he is going to be talking about underwriting and he is also going to be having a case study as well. And big news, you guys, our first live event is going to be on Wednesday, June 29 at 6 p.m. We're going to have my lawyer, Josh Driscoll, as a special guest. He is going to be talking about the importance of corporation entity setup when you are syndicating deals and real estate investing in general. Dexter, you're on mute.
Thank you for that. All right. I'm working off my phone right now. My laptop in the shop getting repaired. Our special guest speaker tonight is none other than Anne Peterson. She's going to be speaking on market updates, interest rates, and understanding debt. She's a senior director at Old Capital with over 30 years of transaction experience. And Old Capital has closed $1 billion in loans yearly. And she's a general partner in Texas, Georgia, North, and South Carolina. Without no further ado, I'd like to introduce y'all to Anne Peterson. Thank you.
Well, thank you, you guys. I am just so excited because I'm your first person. So we're gonna step off and do it right. I'm excited to be here. I met Jason probably 3 or 4 months ago. And I don't know about you, but he has just this way about him that is pretty special. So I said, absolutely, I will jump on a call and help you out. So let me do this. I'm gonna open this up. What I wanna do before we go into my presentation is to kind of take a poll here. So if you open up your chat box, you should see everyone if you're going to send it to everybody. This is the poll I'm taking. If you are brand new and never done a multifamily deal, okay, you have no experience, put 1 in. If you're a limited partner, I want 2. And if you're a general partner, I want 3. So let's see what we got. Limited partner, new folks. Okay. 3, home pride properties. Look at that. Okay. Well, we see people here that know what they're doing. We got some new people that are, you know what, this could be all new verbiage. So if I am speaking a foreign language I want to apologize beforehand. All right. So stop me, because when I got started in real estate, a lot of the lenders would say, go away until you know what you're doing. And I do not want to be that person. I want to be very approachable, and I want to be able to answer your questions as if, you didn't know anything. All right. So I'm going to go ahead and share my screen. Now, why did that do that? Didn't give me my, oh, here, no, let's try this. Here we go. There we go. So do you see my full screen? Yes. Good, thumbs up. All right, great. All right, well, once again, I'm Anne Peterson. I'm with Old Capital Lending. I live in San Diego. I do no business in San Diego. I have a meetup here, but that is about it. I'm all about educating people to do deals outside of the great state of California. We've got just a lot of hangups here. We've got rent control, things that are not landlord friendly. So here's what we're going to do. We're going to talk a little bit about Old Capital, because ultimately I want your business. I want to tell you about us, what we do. I want to tell you what's going on in the market. I want to talk to you about interest rates, and I want you to understand, how do we get these deals done? And then there's going to be a little bit of time for Q&A. Jason, how much time do I have? You're on mute. I want to make sure I'm keeping within my time frame.
So, Julie, you can have as much time as you want, but we're trying to have this as concise as possible. So we're trying to constrain it to about 1 hour.
Perfect. Awesome. All right. You got it. If I get long-winded, tell me to wrap it up. All right. So as Jason mentioned, or Dexter said, I do have 30 years of experience. I was once in your shoes. Again, I think I stayed too long in single family. I'll be honest with you. Okay. Just up until about 8 years ago, I was doing single family. I couldn't get out. Every time I tried to buy another multifamily, they said, go away, because I came from the idea of, I can do this myself. I don't need a team. People in single family need to understand that putting a team together can be so advantageous. So I am here to tell you that I can help you find your partners. I don't just do debt. I put partnerships and teams together. A little bit about Old Capital. We've been in business for 36 years. We've closed actually 6,500 loans. That is a lot of loans. And when you have been working for a couple years, which sometimes these deals take a couple years to get done, you want to be working with a lender or a broker that has great relationships with lenders to make sure that we have execution certainty. So that's what you get with Old Capital, but we also have amazing relationships with brokers. So when you are in the best and final and you are saying, hey, I want this deal, I know it, hopefully you're a friend of Old Capital, because we know that broker and we're going to help you take that down. So keep us in mind, build the relationship now. We do all kinds of loans, but mostly there are bank loans, which are recourse loans. We'll talk about this later. We do bridge loans that are short term. We do agency, which is your government-backed securities. And we also do CMBS, which we're not going to get into today. But we are your resource for lending on multifamily. We do a lot of different types of lending, but our real specialty is in multifamily. We do new construction, office, retail, industrial. These are all the different asset classes, but as you see, about 93% of our business goes into multifamily. Now, how do we separate ourselves from everyone else that is doing, hey, I'm a mortgage broker. Hey, I'm a mortgage broker. We wanted to create a real education platform. So about 8 or 10 years ago, Paul and Michael started the Old Capital podcast. And if you haven't heard it, you're up for a real great time. These are working with real life investors. How did you get through? These are the conversations. How did you get through when one of your buildings caught on fire after your due diligence, when you're almost ready to close? Listen, this is a great platform, and we would love for you to listen. We're on all of the different platforms. So take some time, listen to us. We also do an Old Capital conference yearly, and this is the conference that brings real good quality investors. So if you're looking to build sponsorships, this is the place to be. This is we are attracting a lot of high net worth individuals. We educate them, we network. Look at this. We had Lou Holtz, we had Roger Staubach. We went to the Ranger Stadium last year. We were on the floor of the stadium. It was truly amazing. So come along, September, October. And it's a 1 day. We've got, actually the night before we drink beers. I got on a riding cow last year, a bull. And then the next day it's all learning. So networking. If you haven't been to my Tuesday Zoom at 8, you are again up for a great night. Bill Gross joined us last night, and he's here tonight. And some of you, Jason was on board as well. This is my platform. I put this together about 3 years ago. Just within this community, we've closed 11 loans. We've closed 11 deals. So the people that come, they support the people that get our deals. And it's a really nice ecosystem. So we've got investors, we've got sponsors, we've got insurance brokers, attorneys. They're all coming. The experts are there. Come to learn. All right. We also network after we learn. So relationships are built within these communities. So let's get on to what the heck is going on in the market today. We hear in our news every day, inflation, interest rates, cap rates, rate caps, returns, employment, COVID, Ukraine war. What is going on, and how is that affecting our interest rates, our economy? So I'm going to take you through a brief download of some information that has been shared to many people, but I wanted to direct some of the things that are really impacting our community. So let's take a look. 2 years ago, really impacted, it's where it really started, okay? Back in April 2020, okay, we had a financial crisis. That's 2 years ago. My goodness. We saw some unprecedented response from the central banks and across the world, including ours, with the COVID pandemic. So a financial crisis occurred because of the pandemic, and within about 6 weeks, 7 weeks, we saw a huge injection of liquidity and a stimulus that was necessary to offset this terrible pandemic that was gripping the world. If you look at the GDP, it was at 26%. Right now, that is where we are today at 26% compared to the 2008 when we were looking at the financial crisis at 6%. So huge difference of what was happening in 2008 rather, not 2006, 2008, we were at 6%. And, back then, we didn't have a playbook. We didn't know what was going on. So we saw a heavily impact on the economy. But you know what? We took the steps that we needed to take back 2 years ago with this health crisis that could have been kicking us off into some depressionary environment. Okay. As a result of injecting all of that capital into our economy, you can see we came out in this example, you can see in 2020 how interest rates just dropped incredibly. So if you were in an interest rate that had a yield maintenance loan on a deal, your interest rate was probably about 5% back in 2020. And the interest rates dropped to about 2-3%. And if you wanted to sell that deal and you had yield maintenance, the costs to get out of that deal were enormous, millions and millions of dollars. So, you know, while it was great for people that were buying, but for people that were selling, you know, there was a difference. Well, the difference is that these cap rates were compressing. So while, you know, we had to pay to get out of these yield maintenance penalty loans, these people who are in these deals made a tremendous amount of money. So you know what? Today we see a huge amount of alarm and a surge, and we need to catch up for some of the losses that we have with injecting all of this capital. So the 10-year Treasury and the Fed funds, you can see here, there's been a significant change over since the beginning of the year. You can see here we're up at 293. I think that was the beginning of April when we saw this. We're probably at 2.8. Yesterday was 2.81, I think. So the interest rates are on the move, but don't get pulled into all of this nonsense, because if you look at where we were long term, look at all the way to the right. That's where we are today. If you look at 2018, we're not far off. Okay, look at the long-term 10-year. That's the blue line. The average was 5.7, and we're nothing. Yes.
Julie, so sorry to interrupt. However, we are not seeing your chart.
You aren't?
No.
Well, thank you for telling me that. My goodness, let me get you the chart. Can you see it now? Yes? Okay. Can you see, do you see the things out over on the right-hand side, on the left-hand side then?
Yes, we're seeing the left-hand side now.
And the stuff on the right. Okay. So let me see. Not sure why that it worked before. All right. So you can see here 2018. You can see how we're right around the same interest rate, and there is some alarm, as I mentioned, in our community. But if you look over the long haul, and remember, real estate is all about the long-term strategy, you can see that we're okay. There's no necessarily a reason for concern, although I would tell you that the picture here is showing favorable, but you know, the bottom line is it is cyclical. So are we looking at a recession? Potentially. Okay. How long, when, we just don't know. Okay, here's just another breakdown just to look at it. Oops, let me show you this one. Can you see that? Yes. Okay, so all right, so you can see here just a little bit closer the 10-year Treasury. Okay, we're looking at, just as the highest was December 2018, and we're not there yet. So we have a little bit more to go to be on the same page as 2018. But here's the difference. Back in 2018, we had 2 to 3% increases in rent. Today, you're seeing an enormous amount of growth across the nation. Okay. The average is 19%, but we see some markets at 30%. So is it all gloom and doom? No, I don't think so. I think there's still a lot of opportunity. I do think that there is going to be some change, whether it be on pricing, whether it's going to be returns to your investors. Things are going to be turning a little bit, and you just need to be wise about some of your investments. The other thing that we're seeing is employment. Employment is, during the COVID pandemic, we lost we were at 22 million jobs. We lost 22 million, and we've brought back almost 20.5 million more jobs. We've got unemployment back to almost where we had it before the pandemic. And we've created a historic amount of jobs as well. 6.7 million new jobs were created. Here's the problem. We have people in some sectors that don't want to go back to those sectors. We have people in the restaurant industry and hospitality. My husband's in hospitality. We see this. It is impacting a lot of us. And people are sitting on the couch and saying, I don't want to go back to work for $18 an hour. Okay, well, you come back at 20. How about 25? And all of that is causing an inflationary pressure. And that's what's causing the interest rate hikes. We're trying to get a hold of this inflation. Okay. So where do we see the interest rates going? We have seen and heard that before March, like the beginning of March, we got 0.25% of a rate hike. Okay, we were expecting 0.5% to go up, but we held back because of the war in Ukraine. But there's a lot of drivers, and it is just, everything is expanding so fast. The economy is growing so fast. Interest rates are going so fast. They're moving that we're trying to get a hold of it. And it really is not easy. So if we look at the blue line, which is your 10-year treasury, we've got signaling that we're going to have 2 more increases of 50 basis points. So if we're at two more basis points, that's another point for the year. I've also heard 2, maybe even 2 over the next 2 years. So that, if we're at almost 3 now, and we're going to go up 2, that's 5%. That's just on the rate. You got the spread included on that. Okay, is the short-term federal funds, which is the orange line here, it's expected to rise 6 times, which will bring that to a 2%. Okay, a lot of the bridge loans that are out today are based on these short-term federal funds. So we'll talk a little bit more about that. What's been amazing though is that the absorption of all of the new inventory that's come on has been absorbed. I mean, it's again an incredible time. There is a shortage. Where are these people going? They're moving in with their parents. But now the occupancy rate has gone, it's amazing. We're at 80 or 95, 98, and in some cases 100%. So it is significantly impacting the Americans, and the demand is there. So once again, is it the right time to buy? I think it's still strong, and I think you'll still be able to have passive investing opportunities in the near future. Okay, what we also are seeing is the price of the mortgages. So in this case, you can see that in 2012, when we were in the midst of housing, our financial crisis, the apartments were just as expensive as your mortgage, but as we have things have evolved, we've got smaller amounts of homes available. People can no longer afford a home to come up with a down payment. This difference, this separation between home mortgages and apartment pricing has increased, and we believe it's probably going to continue with the rent growth as we've seen outlined earlier. That is a challenge. Here's a vacancy rate. If you look at Class A, typically Class A, when things get tough, you can see in the blue line, typically we see vacancy go up a little higher on the A's, and they're right all there. A, B's, and C's are very close, 2 to 3% vacancy. It's the highest, or rather the lowest level that we've seen in 30 years. It's truly amazing. So where is the concern? And really looking at the yields that are out there right now for many of these financial vehicles, you can see here with just commercial real estate, you're still at 5.9%. Much better, and you have depreciation. You've got a write-off on your taxes. So if you're considering doing any kind of other vehicles from a financial standpoint, real estate is still very strong. All right, so let's go ahead. Do we have any questions on the market before I go into understanding debt? Because that's really why you're here and how I can help you. Any questions? All right. I don't hear anybody, so I'm going to keep going. All right. So once, as I mentioned, we have different types of products. On commercial, you've got recourse and non-recourse products. Recourse is going to be a personal guarantee. You're going to be signing on the loan. It's going to hit your credit score. It's going to hit your balance sheet. If something happens, and you will be personally responsible for any makeup or default. We also have non-recourse, which you are still signing on the loan, but you are not guaranteeing it personally. Okay, that is an agency loan. We also see that in bridge financing. So again, we've got bank lending, we've got agency, both small balance, which is 1 million to 6 million, or we have conventional, which is 6 million and above, both in Fannie and Freddie products. Those are your agency loans, and we'll go over this, as well as you have non-recourse bridge. 80% of the deals today are in non-recourse bridge. Okay, non-recourse bridge is your short-term lending. So let's go over first and foremost bank, because if you're coming from single family, most of us think about, oh, I need a pre-qualification. In commercial real estate, there's no such thing as a pre-qualification. Now, some of the brokers out there will say, hey, I want to see if you can qualify. Now, on bank, maybe, but most in commercial lending, you're going to be doing a syndication, which is a grouping, a conglomeration of capital that you're raising, and you're going to go as a group to invest. So on bank, again, this is a recourse product. It's typically you want to have this bank to be close by or in the region as the property is. So let's say you live, obviously you guys live in Los Angeles, and you want to buy a property in North Carolina. A bank here, if you've got a relationship with your local bank and you say, hey, I want to buy this property, I've been with this bank for 30 years, that bank will probably give you a loan over there, especially if you have experience. But if you don't, many of these banks will say, go away, just as they did to me for many, many years. So a bank is, again, going to want your personal guarantee. They want to have a relationship with you. If you're buying in North Carolina, you got to find somebody who will help you with that. They will be boots on the ground, somebody you can call and say, run down to the bank, run down to the property. Okay. A lot of these banks, when we do bank lending, we're going to start at $1 million. That's the loan amount. So there are banks that will take lower. We typically get involved at 1 million on banks. Okay. Typically a bank, and all banks are different, because some want to just have deposits from your aunts and uncles and your grandma. They don't, they're pretty conservative. They don't want to necessarily give you 70 or 80% loan to value. They want to maybe be a little bit more real, a little bit more conservative. So as a whole, we see about 75% of the loans being done at 75% loan to value. Okay, so when you think about banks, think about 75% loan to value. These are typically 5-year loans, and they're amortized over 25 years. Now there again, you might find one that's 20, you might find one that's 30, but typically on average, it's about 25 years amortized, okay? You might get a year interest only, but they're gonna want to look, I hate to say it, in your underpants, because they wanna know that you are going to pay them back. So they're gonna look for your tax returns, they're gonna look for statements, they're gonna look for your personal guarantee. And it will, if you want to buy a house, here's where the biggest impact is. Let's say you wanna buy a new house and you put on recourse bank lending on your multifamily assets. You put on a $3 million deal on your personal financials. You want to go buy a $400,000 home. Okay, well, 400,000 is probably not going to get you anything in LA. So maybe you want to go get a small condo for $1 million in LA. And you have this $3 million deal over in North Carolina. You're probably not going to be able to buy that $1 million home, because I have the 3 million that's sitting on your credit score, on your balance sheet. So be thinking about that when you're looking for debt. Many of the syndicators and investors that are investing in the deal do not want to be involved in a bank recourse loan. Okay, but they're out there, and they're right now we're seeing more of a surge on the bank lending, because everything else is so expensive. Okay, so let's talk about this bridge lending. Bridge, again, is bridging you from unstabilized. And many times we talk about stabilized as in less than 90% occupied for 90 days. Okay, so if you've got a deal that is 75% occupied, the agency will not take it. So you're going to have to find either a bank that wants it or a bridge loan. Okay.
Excuse me,
Stabilized.
Julie.
Yes.
Apologize for interruption. Can you change the slide?
Yes. Thank you.
No problem.
Appreciate that.
Thank you.
Sure. Okay. So bridge can be bridging you to a stabilized asset. Maybe the previous owner, they didn't know how to manage their deal. So they're at 75. You're going to do some renovations, maybe $5,000 a door. You're going to get the rents up. And then after 3 years, you're going to be stabilized. You're going to be 90% occupied for 90 days. Okay, perfect. Your loan is going to be maturing. Where do you go? You got to know that at the beginning of the story, when you decide to get into multifamily and you decide, hey, my investors want to be in a deal for 10 years, you got to look at this deal and say, I'm going to hold it for 3, then I'm going to go find another loan. Who's going to take it? These are the questions you have to have very clear answers before you get into the deal. Because what happens if you think you're going into an agency loan after a bridge and you find out 2 months before you have to get out that agency does not have any interest in your loan. And now you have to go, you told the investors you were going to agency, which is a really good loan. And agency says, I do not like the middle of Oklahoma. I have no interest in it. And you were thinking you're going to take your investors to the next step. Now you have to get them out. And that is not a good situation. So having the forethought, where am I going? What are the steps that I'm going to need to return capital after the bridge loan is very, very important. So let's talk about bridge. This a ton of information I'm ready to give you. So if you're not taking notes, the time is now. Go run and get your pencil and your pen. This is really important. So again, we've got bridge, that's non-recourse, okay? There are fixed rate and there's adjustable rate bridge loans. Let's talk about fixed first, okay? Just like your home mortgage is fixed, awesome. There's not a lot of risk. But for a lender that is taking on some of these, it's gonna be a little bit more expensive, about 2 points more expensive on a fixed rate loan, especially if it's non-recourse. Now you can go get a bridge type product through a bank. I'm not talking about that. That would be recourse. And those are popular, as I mentioned. Right now, they're starting to shift that way. But on bridge product, non-recourse, I can go down to $500,000 loan amount. Most people won't go down there. I can do that. Why? Because I work with a lot of new investors and I want to hold their hands. Some people start out small and I'm going to be there for their first, second, and third property that they're buying. So we can start out small. Again, I don't want to be this lender that says, get out of here. It's too small. Okay. Here's what you've got. You've got about 2.5% higher rate. Okay. You've got about a 75% loan to value. Okay. That's just for the price of the property. So on a $10 million deal, you got 75, that's going to be $7.5 million. Okay. On top of that, you're going to have a rehab budget. I can roll that in to the loan. Let's say you have $500,000 in a rehab budget. Many of these bridge lenders want you to have at least $5,000 a door. Take a note, $5,000 a door. It's not very much in this economy. That's about some paint and maybe some flooring, seriously. So be realistic, get really good quotes. Okay, so now I've got an $8,000 loan and I only need to bring in a small amount because I've got that, I'm rolling in that rehab. It is truly amazing. These are 3 years of interest only. So you got all of these rents coming in and you have a little bit going out. Now you've got that for 3 years. I'm going to have a minimum interest, meaning you have to be in this on a 3-year loan for 18 months. What happens at 3 years or 2.5? Oh my goodness, I can't get out of this. I have some extra work to do. Okay, it's okay. We can give you an extension. Those extension cost you 1% for 1 year and another 1% for a second year. So in essence, you could be in this deal for 5 years. Not optimal because you're paying 2.5 to 3% more interest, probably 2.5 at this point. Okay, this is based on a 30-year amortization. So compared to a bank, you're talking about a smaller monthly payment. I'm going to need net worth. How much? I'm going to need net worth greater than the loan amount. So in that case where I talked about $8 million loan amount, I'm going to need net worth greater than $8 million. Now, where do you get that? You get that from your people that are on the general partnership with you who are guaranteeing this loan with you. Okay. Liquidity. What the heck is that? That's cash in the bank after you close. I need 10% liquidity. Okay, cash, marketable securities. So in this case, I need $80,000. I'm sorry, 800,000. That's 1%. 800,000 in liquidity. That has to be sitting in the bank. We're going to ask for statements. Can't be, on a credit card. You have to have it, and you got to find those partners that are going to help you sign on the loan. Okay, experience in these bridge loans. They can be very volatile. So I need somebody who's done it. We like to see experience on these fixed loans. Some of these smaller fixed loans, if you've got single family, we can use that. But typically doesn't work. You need to have, on some of these larger loans, I need to see experience. So I'm going to need to see your personal financial statement. Write that down. I'm going to need your schedule of real estate. That's SREO. And I'm going to need an understanding of what you've done in your experience. Put it on a resume. Okay. When we look at these bridge loans, I need to have your T12, your rent roll, your CapEx expense. I need to have rent comps. I need to have sales comps. I need to have your pro forma. Okay. When we look at doing a bridge loan, we're looking off into the future. You look into your crystal ball. Your crystal ball says, I think that in the future, we're going to have 10% increases. Well, that's what our banks look at. And we're going to hold you to that, to go from an NOI of 100 on day one to a NOI of 400. And we're going to watch you do that. Okay. We're here to help. All right. But there are more costs associated with bridge lending. Okay. I talked about the fixed. The adjustable is where we get these extra costs. Okay. This is very important. Write this down. On a bridge, you're 75 to 100, 50 to 75,000 in your application fee. Okay, that's a lot. On an agency, you're looking at 10, 15,000. This is much more expensive. Okay, you've got 1% in, 1% out. 1% of the interest of the loan amount to go in. Again, you're only paying interest, and to exit 1%. Okay, I also have a fee of 1%. You have a DACA. That's a deposit and clearing account. Okay, what is that? Some of these bridge lenders will say, I want to make sure that I see this money coming in from your deposits, from your income, and I will pay all the bills and I will send it back out to you. That's called a DACA. Some bridge lenders say that's the way we're going to manage it. Some of them say, if you default on this, we're going to send you to the DACA account, and then you're going to need a little help. Closing costs are about 4%. Right now, I would even estimate 5%, because here's why. You need a rate cap. A rate cap, you got to write this down. A rate cap is an insurance policy on a bridge or a adjustable rate mortgage on commercial lending. Okay. Think about when you go to take insurance out for your car. If you want to make sure that any kind of possible damage to your car, you only have a deductible of $250, your rate on that is very high. You say, I never am in any accidents. I'm going to go for $1,500 insurance policy. The cost of that policy is much lower. Same with these rate caps. Rate cap is an insurance policy on an adjustable rate mortgage that is a protection. But here's the thing. These rate caps are very, very expensive. So let me give you an example. I'm going to give you a bridge loan for 5%. Okay. We're going to ask, the lender's going to ask for a strike, this rate cap, and the strike, which is the difference between how much it adjusts, of 1%. Okay. So you have to go out and buy a rate cap that's going to hold it 1%. Now, in this environment, that may be $100,000. So that takes your 5% loan to 6%, and you still have to pay it. If it goes above 1% of that strike price, it'll be covered by this insurance policy. Well, that seems easy. Well, it does, but we just had a recent increase. And here's how it went. I was in a loan. I was in my own general partnership. It started at 30,000, and that was a 1.5% strike. And it was 30,000. It got so expensive, we had to move the strike price to 3%. Okay. I went from $30,000 to $129,000. That's a lot. When you think all you are thinking about is 30 and it gets to 129, that's a big increase. But here's the real problem with this. You're going along. I'm going to I can go from 5 to 6.5. Okay. I'm going to get it covered. I check the stress test and it works. Well, these strikes had to go to 3% because it was 129,000. I couldn't pay any more. So what does that mean? I have to go from a 5% loan to an 8% loan. I have to be able to cover that with the income and the expenses to cover my mortgage. Did you stress test it? Not many people do. Okay. They say, I just want to get into this deal. This is going to create some problems for us in the future, and you need to know about it. So if you're looking at taking on bridge lending, reach out, we'll discuss it, because you don't want to find yourself at an 8% rate and all you have, it goes to 8.5. Oh, well, that's great. You get that covered by 0.5% by your $129,000 rate cap. Okay. This is real. This is happening. You're going to see some new investors that got into this over the last 10 months, 12 months that might not have stress tested their deal. And it's going to be of concern. Okay. The other costs involved are your legal. Okay. The bank lending, their bank lender legal costs about 35. Your own legal costs about 30. Oh, I got a question for the lender legal. Oh, that goes up. I had a lender legal that was over 200,000. You didn't underwrite that. Every time you pick up the phone to that lender legal, it costs you money as well as your own. So make sure you are underwriting pretty conservatively on that lender legal, because it is high. Okay. These are shorter term, as I mentioned, 3 years. You got to have that exit strategy, as I mentioned. And can you execute that plan? This is something that I'm happy to take you through again, because it is real. Okay. Last thing, agency financing. As we talked about what is required for agency. It's your net worth, your liquidity, your experience. And in agency, we're going to look for 2 years of experience as a general partner. Well, I just got into this. That's why you need a sponsor, somebody who can hold your hand. I don't want anybody holding my hand. Well, then you better stay in single family. This is a community. This is teamwork. Okay. 2 years experience, 3 to 5 transactions. And here's what I'll tell you. I was on a deal on a Freddie, and the person who I was working with, the sponsor, said, yeah, I have transactions. I said, do you have 2? Yep, I do. They didn't. They only had 22 months of experience. So what did Freddie say? Sorry, can't do it. So this is serious. They do take it seriously, and you got to find a sponsor that has checked all these boxes. Now that can be one person for each of those, but here's the deal. Keep in mind, the more people you have on your team, the more personalities, the more people can't make it to the meetings and they don't agree. And more people take more money out of your pocket. Okay. The less of the pie you get. So again, this is the long game. Take your time, find your partners, somebody that you know you can work with. Don't put your investors at risk because you don't like your partner. Make sure this is a long game with you and your partner. The last thing on this agency is 90% occupied for 90 days. Oops. Once again, Dexter, you forgot to change that.
Yes,
Here it is. There it is, the breakdown. And I can certainly send over these slides for more information. So here's the update on agency. Agency is debt service constrained, meaning in a lot of these markets, the pricing of these properties is so elevated. A lot of the deals do not work at 75% or 80%, which is why agency was so amazing. You could get a 10-year loan before COVID. You'd have 3 years interest only, and you'd have a low rate for a very long time. Why wouldn't you want to go to this? This is the gold standard. But with compression of the cap rates, you know, we've got these high prices because everybody's doing multifamily. You're really seeing 50, 60% loan to value. And that's why there's been such a surge into the bridge lending. Okay. So I won't take a lot of time on this, but they're less expensive. If they work, they're less expensive. You can get into them for a longer period of time. If you decide to change, we would structure the deal so that you would have a step down payment. There's 2 different types of prepayment penalties. There's yield maintenance and there's step down. So we could structure it however you want it. But for every change to the standard loan is going to cost you money. And when you're only getting 50 or 60% right now, these are not necessarily your best strategy right now. But keep in mind, and the smart ones in this community are doing more lower leverage loans. Yes, you might have to bring in more money, but you want to take care of your investors. And if you're new, you don't want to put them at risk. So lower leverage can go over the bumpy times of the year, of the month, however long we may be in a tough time. The lower leverage is going to give you a little bit more security. So again, I'm a consultant. I can help you navigate, figure out what your strategy is. And that's what we do. Okay, so those are the 3 types of loans. Again, I'm not going to cover CMBS. We don't do a bunch of it. It's really for deals that don't work on Fannie and Freddie, or maybe student housing, or some others that we could talk about if you're interested. It is a non-recourse, so that's helpful. All right, real quickly, you're saying to yourself, well, when do I get a hold of you? Okay, call me before you get a PSA signed. I say, call me before the LOI, because I can give you some high level indication. Maybe you're underwriting these at 3.5, because that's what it was 4 weeks ago, or 5 weeks, 10 weeks ago. Don't do that. Call me. What is this going to look like, Julie? Okay, let's have a conversation. You sign the PSA and we start the clock. Many of these deals are 60 days. So you're going to give me all your due diligence paperwork. Due diligence is your personal financial statements, the rent rolls, T12. We're going to ask for a lot of paperwork. We're going to collect that for about 30 days. I'm going to hand that in, and then the lender is going to start asking questions. Hey, that looked kind of crazy. Is this month to month? It says that it's not month to month. Is it month to month? So you're going to start to ask questions. Now, if you're on a Freddie loan.
Excuse me, Julie.
Yes.
Sorry about that. Next slide.
Thank you.
No problem.
And I am failing this one.
No, you're doing great. You're doing great.
Okay, perfect. Thank you. I only have a few more minutes. So you want to make sure that you get all those due diligence pieces in, okay? The thing about Freddie, what I love about Freddie is you can lock it when you sign the application. Then if the rate goes up and down, no problem. On Fannie, it continues to adjust until about 5 days before you close. That's when you get the commitment letter from the lender, from the agency, says this is what we're going to offer you. We told you it's going to be this rate. We told you this is what we're going to cover on the loan proceeds. And here's your loan. Please sign, and we go to closing. Okay, that's about 5 days. So if you're in a deal where it's critical that there's no movement, you might want to think about Freddie. I got a real quick story. Talked about those rate caps on the bridge. My goodness. So one of my deals was a portfolio, and they started out with a rate cap budget of 1.6. That's just for the rate caps. When they went to close, it was $4,300,000. Okay, that's how volatile the market has been recently. And that is why sometimes it's better to look at lower leverage agency loans with a Fannie, with a Freddie, where it locks it in. Okay, so just some things to be thinking about. I know that's a ton of information that I just dropped on you, and you may be feeling overwhelmed. And I understand that, but it's important you got to start someplace with this information. So should you buy now? Well, there's a lot of opportunities out there. Okay, the rates are still low, as you know, in regards to the market over the decades that we've been in business, right? There's still acquisitions, there's refinances, there's assumptions out there. You want to know your market. You want to know what the standard cap rates are in that market. You want to be an expert. Okay, you want to know what kind of tenant base lives in this property. And if you're going to be doing a heavy value add, maybe you need to know what are the items that a better quality tenant wants. Doesn't matter if you're changing the color to what a B tenant wants, that's great. But if you don't have the right amenities, or you don't have the right security for that type of tenant base, you may be missing the mark. Okay, so that's a whole nother conversation, but you need to be thinking about these. So you also need to be surveying your investors. Do they want to be in a long-term loan? Do they want to have a fix and flip model like you've done in single family? Are those the types of investors you have? And make sure you're finding the right product, the right opportunity, and the right debt to go on that opportunity. It's very important. Okay. All right. So one last thing I'm going to leave you with. At some point, your timing is right. So you have to figure that out. Do you have your team? Do you have the money? Do you have the support of your family and friends for your investing, for your to pull from, you know, as investors? So that's all I have for you tonight. I got it right on the dot. So what questions do you guys have?
So I saw a couple questions pop up in the chat box, so you guys feel free to ask Julie questions. I have a couple questions as well, but I will go last.
Okay, Raphael. Raphael Luna, you're on. You have a question.
No, I was just clapping for you.
Oh.
You did a good presentation there, and thank you for coming on, Jason, Dexter. This was awesome. And
Oh, thank
I
you.
hope we can get the presentation or the slides. It was a lot of good info.
A lot, exactly. I'm
Yeah.
taking notes myself.
I
Exactly.
appreciate it, Julie and Jason, Dexter. I appreciate you guys.
Oh, thank you so much. I appreciate that. The great thing about real estate is you can think you know everything and you'll find one more thing today, another one tomorrow. It's amazing. Okay, who else? Any other questions? Did I miss? What is an FHA loan? FHA is going to be a government loan, and yeah, it depends on who you talk to, but FHA could be considered HUD housing, which is urban development, housing and urban development. They are non-recourse. Yeah. Do banks typically lend to syndicators without a personal guarantee? Well, you're signing on the loan that I'm going to take care of this loan. I'm going to deliver what I told you I was going to. Now, there's always the possibility that you make some poor choices. There are some people, Bernie Madoff made some poor choices. Okay. And if you make poor choices, that non-recourse loan will turn into recourse. And I'll tell you this, you don't deliver on a non-recourse agency loan, that will be your last deal. Okay. Here's another thing. We didn't talk about it, and I could go on for hours because I love what I do. I don't know if you know that, but
Yes.
there are people that are sponsors, and God love them. They want to get on every deal, and they'll either get paid or they'll want to have certain equity position. Okay, you got to be careful. You got to know what the SEC, Securities and Exchange Commission, allows, because you cannot pay people for being a sponsor. But here's the deal. A lot of sponsors do this full time. So think about that. They used to be a computer analyst, and they said, you know what? I want to be full time. I make enough money doing this. I'm going to do it full time. Now you're a sponsor on this deal and you say, thank you, take care. I'll come check on that. I trust that you, Raphael, will take care of this. I know it, but I'm here over here. And they're not keeping an eye on the new general partner. And Fanny drives by and says, ding dong. Hello, Julie. Have you been by the property? Oh yeah, I go by all the time. Why? Oh, that's interesting because there's some things that have not been taken care of. Oh, really? What? Well, we got into this loan a year ago, and here's the list of things that you did not do. Oh, I'll check on that. Well, thanks, but we're going to put you on the A checklist. What's that? Well, basically, they shut you off. No more. You're not getting any more loans. In fact, we're going to either put you in the penalty box and you can't get another loan, or you better fix it. But that's a problem on your record, right? So if you work with a sponsor, you must stay in contact with them, because now the sponsor needs to go back to full-time work. He just said, I make enough money in real estate. Well, his dreams of being in real estate full-time just got killed because you did not keep an eye on that property. So be very aware. People don't know that. Oh, I need a sponsor. Oh, I'll do that. I'll work with you. Oh, I'll work with you. A sponsor needs to be compensated, meaning they have to have ownership. They have to be part of it. That they're there to help you. Make sure you have a relationship with that. All right, let's see. What is the interest rate delta on a non-recourse loan? Interest rate delta on a non-recourse loan. I'm not sure what that means.
Mhm.
Can somebody tell me what the question is? Or maybe they left. I don't know.
Yeah, I believe that person.
All right.
left.
You already answered the question. You basically said it's 2%. Got it.
Okay,
All right.
thank you.
Good.
Rate of change. So, sorry.
Okay. Vessi, great to see you too. Anybody else? I don't think I see any more questions in the chat. What is an agency loan? We went over that. Once a property is rent stabilized, can't the property itself be underwritten without recourse? Well, then you would go into a non-recourse loan. So you'd refinance out of that and go into a new loan. You want to get out of these because, bridge is going to be a little bit more expensive, as I've noted. You want to get into the cheapest product if you can, because all that money is going to go to your investors. Do banks typically lend to syndicators without a personal guarantee? No, not often. All right, I think I've got it all.
Okay.
Anybody else? Again, it was a ton of information. I could have probably shared one thing and that would have been it, but that would have been no fun.
So I have two questions.
Okay,
for you,
good.
Julie. So first question is, would you mind telling the audience how we can sign up for your conference in October?
Yeah, so I would go to, right now, I don't think there is anything there, but if you go to www.oldcapitalconference.com, you'll find the information. If you link to me, make sure that now you're an investor, you need to have a web presence. Get linked into me, get Facebook linked into me. Make sure your information on your Facebook and your LinkedIn profile talks about being an investor. And the more people you're connected to, I mean, as always, that's going to make a difference of who wants to connect with you. Okay. If I don't know you, I probably won't connect with you. So send me a note. Say, hey, I was on the MFM tonight, yesterday, last week, whatever, just so that I will let you into my network. Okay. Kind of crazy, but that's how it is. That's how it goes. Now, the other thing I want to share is the Zoom at 8. Okay. I talked about it. I'm going to drop the link here in a second for you. And I think most of my investors would say it's worth the time invested in this every Tuesday night. It's just some amazing relationships have come out of it. All right. What else? Jason, you have one more question?
Yes, and you said previously that it took you 3 years for you to find your partner.
Yeah.
And if you could give us one tip on how to find a all-star partner that will complement our weaknesses, what would that one tip be?
Well, first of all, you need to know what your superpower is. You have to know if you are good at underwriting. That's not my forte. My forte, and by the way, I didn't know this, that I can be a pretty damn good capital raiser. I just capital raised $4 million. I didn't know I had that capability. So figure out what that is. And you won't know that until you start getting into multifamily underwriting. Maybe you're really good at communicating with investors. So you're the investor relations person. Well, you're partner, you don't want to have the same characteristics that you have that they have with you. All right. So for me, my tip would be first figure out what you need and go out and start talking to people. This is what I'm looking for. When you come onto Zoom at 8, this is what I'm looking for. Every time you get in front of people, this is what I'm looking for. Is that something that you could do? No, I can't. Okay. Do you know somebody who could? Everybody wants to help each other in this community. Very different than single family. Okay. There are lots of good people, but as we all know, when there is money involved, people act differently. And that is why it took me 3 years to find my person. And I feel so grateful. And I hope that you guys will have the same experience when you find that perfect partner. And it may not just be one, it could be 2, it could be 3. The smaller your group, the much better it is. I encourage you, do not go to these conferences and start shaking hands and saying, you're my partner, because you have no idea if they don't like to get up on a Sunday morning and have a conversation, because that's when it works for you. My partner, she's in the East Coast. I'm on the West Coast. We talk at 6 in the morning. We talk on Saturdays at 10 p.m. We are always available to each other. That's what I wanted. That's what she wanted. I could not deal with sassy. If you did not get on a phone call with me on a Thursday night when I wanted to talk to you, I'd be kind of mad at you. So, we kind of have to figure out what works for us. Long-winded, but that's what I say.
Thank you very much, Julie.
You are welcome.
That was such a value-packed presentation. We learned so much from you.
Thank you.
And let's continue. So we've already done the Q&A. We've learned so much, and thank you again, Julie, for answering all of our questions.
You are welcome.
All right. Thank you, Julie.
You're welcome,
Very
Dexter.
informative information. Once again, everyone else in the event, this is our reminder for our next event. It'll be Charles, which is Jason and I mentor on underwriting. The date is May 25th, 2022 at 6 p.m. We'll set this up in the meetup.
This is a must.
Yes.
You must meet Charles Seaman.
Mhm.
This guy on Saturday afternoons
Yes.
is open to you joining him, and he walks you through an underwriting session. He is amazing, you guys.
Yes, he
You're
is.
very lucky to have him join you. You will love him.
Okay. And once again, you guys, if you want to reach out to either Julie, Dexter, or I have provided our contact information and our respective websites on the screen as well. So I'll give you guys 30 seconds to take a screenshot or take a picture with your smartphone. Okay, and moving along, 5, 4, 3, 2, 1. All right, you guys. Go ahead, Dexter.
Go ahead. Thank you. Thank you, everyone, for joining tonight, being with us. One of my fears that I'm getting over is speaking in front of large groups. So this is how I'm overcoming that fear, by becoming courageous and doing this. So most definitely, thank you, Jason, for reaching out to me and asking me to be your co-organizer. I appreciate it, buddy.
Yes, and once again, I want to thank Julie, and I want to thank everybody for showing support and lastly, I want to thank my partner, friend, Dexter Harris. This would not be possible
Oh,
without you guys. So thank
Thank
you again, you guys.
Man,
Have
you
a great night.
you
Good
too.
night, everyone.
Good night. Thanks so
Thank you,
much.
Julie.
Talk to you
Thank you.
soon, guys.
All right.
I hear some birds.
Right. That's probably my background. Yeah. Gave a lot of very